Uh, Thank you for coming to the Seattle Angel Conference Workshop Series. We really appreciate that you're here. We use this to help entrepreneurs make progress with what they're doing with their startup and to help grow new investors. We'll start with introduction.
Yeah, thanks so much. And great diverse group of startups and entrepreneurs represented. It's very, very cool to see. And that does help me in thinking about the presentation for today. So my background, I started as a management consultant way back in the history books, helping big companies go through Lotus Notes implementations. So it was the first time these companies were kind of doing the idea of collaboration from one central place. And I was the young consultant that would come in and help them understand how you become a knowledge sharing company. That idea kind of took root with me through a lot of my career. I really wanted to be an entrepreneur. And so I left the consulting world and entered the startup world. Ended up founding a company called Jive Software, which we bootstrapped for 5 years. I'll talk a little bit about this in the presentation. Raised money, reinvented the business, grew it really fast and furious. And the board wanted to take it public. I moved into the chairman role as opposed to the CEO. I didn't want to be a public company CEO at the time, and moved on to doing investing, advising, incubating, everything under the sun. I was a venture partner at Andreessen Horowitz for a couple of years, missed being operational. And instead of starting new companies, I realized there was this huge opportunity for a lot of the companies that had been chewed up and spit out by the venture model, where they had raised too much money and gotten stuck. And very few of the startups were kind of making it through that gauntlet. So I got in this mode of acquiring these stuck companies and transforming them for a healthy future, letting them live their destiny. And so I've been doing that work for a couple of years now, most specifically with one company, which is a case study for the book. So I've actually written a book about this, and was kind of what today's talk is about, called Fighting Shape. And the company I've been working on for the last several years is this real-time case study for how you go through one of these transformations. And as you'll see, it actually turned out to be a much more interesting case study than I would have possibly imagined at the beginning. Much more challenging, much more reflective of a real entrepreneurial journey, but hopefully with a really interesting outcome at the end of the day, and one that is actually really playing out in real time, as in this week. So if you stay tuned to the end, you'll get a sense of what that Shakespearean drama actually looks like. So that's my story, entrepreneur at heart, and love doing this, and now do it through these other businesses that have gotten stuck and helping to transform them. So I'm currently the CEO of Mobilize, which is the aforementioned company. I own a few other businesses. I'm a partner at a group called Metamorph Capital, where we're doing this at scale. And we just did our first acquisition, which was a $13 million SaaS business. With a lot of the same characteristics that I'm talking about, where it had just gotten stuck in the venture model, and we help kind of clean it up, get it focused on what it does really well, get it profitable and growing, and essentially taking these wannabe unicorns and turning them into businesses that even Warren Buffett could love. So that's kind of what I do. And the book and the talk today are really about that. For the rest of the world, it isn't, the lucky small percentage that actually make it to that breakout percentage. What happens with them, and how can you kind of restructure them in a way that reflects the real market realities that they're facing. Okay, good.
Yeah, that's great. Do you have a link to the book that we can put into the chat?
Well, no, again, the book is finished, but it's not out there yet, because this case study that I'll be talking about was the kind of capstone to the book. So imagine there is 8 chapters that kind of tell the whole story. I know I just jump into the presentation. That work, John? And I'd love it, if, we make this as open and, unstructured as possible, and feel free to jump in at any point. And I'll say that because you guys are the first ones who are getting this presentation, because the book's not out. So it's very raw. In fact, I didn't even have slides until this morning. So it's pretty real time. The content is very familiar to me, but I'm not used to delivering it in a presentation type context. So I think it's going to be much more interesting. We just got to jump into some of the ideas behind it. and see where it goes. And hopefully they're relevant. Even if your company's not stuck, even if you're doing really well, a lot of the concepts that underlie the book should be highly relevant, and both in terms of what not to do, the things that you can avoid, but also just how to run a lean, driven, purposeful, disciplined company. Everybody see that okay?
Yeah, it works great.
Okay. Was that okay? So let me start with the Jive, which I mentioned, which was a company that we founded in 2001. This was a company that was doing social software for large companies, essentially. And we bootstrapped Jive for many years. So it started literally, my first day to meet them was the other two founders was September 11th in New York City. And so obviously, not the best time in a lot of respects to be doing a startup. There's no money to be had. It was very challenging. But in some ways, it made us really disciplined, and we just had to make money out of the gate. And we had to fight for everything that we did. We had to, fight for what we could eat, basically. So we were bootstrapped for a long time, first in New York City, then we moved to Portland, Oregon, and just continued to do what we knew how to do, which was sell software, build and sell software. And that worked really well. And at that period of time, as we grew in a pretty healthy clip over the course of those years, I was also trying to figure out what could we do on a larger scale. How could we really grow this business in a more meaningful way? And how can we tap into a larger market opportunity? But given that we had no board, we had no venture investors, we were able to bootstrap our way and be profitable. We were the masters of our destiny at that point. And that meant that we had the time and space to be thoughtful about figuring out what that play was. And there were a lot of different strategies that we tried that ultimately didn't work. But if we had raised venture and we had that investment breathing down our neck, we never would have found ultimately what was the market that got us to scale and to really grow. So we got our way over the course of 5 years to a profitable $12 million business that we owned. And then after all that experimentation, finally figured out what we wanted to do and raised 15 million from Sequoia at a 50 million pre, which in this era, if we had $12 million of profitable revenue and growing it over 2x a year, who knows what that would be worth. But the VC market has gone bonkers, as I'm sure you know. Anybody that's got any bit of traction is getting huge checks, and I do think a lot of people are going to lose a lot of money in this. It's a little chaotic right now, and I'm seeing it firsthand. So we raised that 15 million from Sequoia. That kind of changed the way that we were operating, and we were told to grow. And so we hired a bunch of people and tried to do what we were doing, but on a larger scale. And this was back in 2008, and it was chaotic. And we had a lot of people that just weren't capable of executing in the startup that we were doing, and capable of executing in a new market. And so we made a lot of bad decisions, and we grew the company too fast in the wrong directions, hired the wrong people, and it got really slow and challenging. So at October of that year, when the economy cratered and Lehman went under, we did a reduction in force and cut out a lot of the people who just weren't working in the company. So cut a third of the company, went from 160 people down to 110 or something. And then got back to what I called fighting shape, which was we had this group of people who cared deeply about what we were doing. We had a plan. People trusted the management team. We were hitting our marks. And we were able to accomplish a lot more with a much smaller driven group of people than we ever were with that larger group of people. And in 2009, we just exploded and went past 50 million and were cash flow positive. So it was one of those moments in time where I just saw what really excellent execution looks like and what a profoundly powerful culture looks like. And then coming into 2010, the board was very aggressively wanting to take the company public. I was, had little kids at home and was on the verge of a divorce, and it was just taking it out of me. So I had that crucible moment of, do I become the public company CEO and go with this thing, or do I kind of peel out and take care of the family? And so I chose the latter. But then, watch this team come in and raise a bunch of money, first in the venture markets and then in the public markets. And then, run it in, again, this kind of bloated, grow at all costs, try to hit quarterly numbers capacity, and lost track of innovation. So I looked back on this story and realized that it was those periods of discipline and austerity, those periods of fighting shape, those periods where it was a team of people who felt like they could take on the world, even if they had to work really hard, and who took care of each other and who lived the values of the company. Those were the periods when amazing things happened. And those times when we raised too much money and we tried to run a playbook approach and we tried to grow too fast was when things went sideways. And I since saw that play out hundreds of times with companies that I worked with as an advisor, as an investor, and the mechanisms by which people apply pattern recognition and a playbook to their growth that comes through the lens of these VCs is often what gets them into trouble. So it was that core problem that kind of led me to this book, which was that getting on the venture capital train is not right for most of the companies that do it. This is nothing against venture capital. There's nothing against private equity either. It's a thing. And some companies need that thing and some don't. But the reality of it was it's a hits business. It's a one, and I've seen it because I've been a VC. Most of the money is made from the 1 out of 10 that are hits. And the VCs can operate that way because their risk is spread out across all these companies, and they can do really well when they make a huge return on one of their portfolio companies. But as entrepreneurs, that's pretty brutal, right? We have a less than 20% chance of seeing a dime from these companies. And I just don't like those odds. I don't like that, entrepreneurs are reading the stories and wanting to keep up with their peers and doing whatever it is to see raising money as a victory, in a sense that raising money is not the victory. Raising money is just setting a higher bar for what victory looks like in a lot of cases. So it was that core problem that I was like, I think there's something missing. There is a whole infrastructure that surrounds startups and entrepreneurship that is misaligned, where the approach of a lot of the VCs out there to push these companies as hard as possible to see which of these are going to be that 1 out of 10 is causing a lot of unnecessary damage to the founders and the teams. And a lot of companies that could be great within their market, even if they're not unicorns, will never even get a shot to do that. So that was what I was seeking to approach head on. I'm more like a Depression era founder, entrepreneur, than your typical VC. And right now, as I said, it is, entirely out of control with the valuations that are going on out there and the checks that are being written. And I think there's going to be a brutal hangover from this period because we've seen it before. So to me, that was the big problem, was the misalignment between entrepreneurs who care deeply about their companies and who are aligned with a purpose and who care mostly about what they're doing, and the financial infrastructure, which is in support of these companies, which is pushing. And if you don't make it, you're gone, and it breaks the company. So what I was trying to dig into more was saying what I've seen firsthand is that if you can stay as lean as possible for as long as possible and possibly even get to profitability, you have the time and space to experiment thoughtfully, to focus on your core business, and to get to the, I think this could be interesting with the Chasm person, Warren, I think your name was, that it's not the same as a beachhead, but the core, the idea of the core business, and being the best in the world at that one thing and ensure that you kind of win that market above all, first and foremost, and be great at something is the best perch from which to identify breakout opportunities, or at the very least, figure out the healthiest growth path for the business. I'll stop there. I've been talking a lot. Is there any questions, thoughts?
Yeah, David, this is Alicia. I started the introduction with identifying with, all my quals as a minority person, right? And so one of the things that I'm concerned about or interested in getting opinions on is the funds that are bubbling up that are very specifically targeting, what they call unseen entrepreneurs or undervalued entrepreneurs. And I'm curious about just people's thoughts on how that might, I mean, I want to say it's irrefutable that there's a benefit for them to exist, but how do they fit into your concern about the craziness of the VC market?
I haven't approached, first of all, I am glad that it's a conversation that's being had, and I'm glad that there are, and by the way, I just dropped off my non-binary, still considers themselves lesbian, oldest child at Reed College last week. So,
Reeds.
Yeah. So you can kind of get a sense of where I am on the spectrum of embracing all of the unique differences and everything else. And I'm glad it is a conversation that's out there. I think because, at least the funds that I know, and whether it's, by economic or racial divides or gender divides or, whatever it is, that they still have this need to have the IRR. They still have this need to hit the return on investment first and foremost. And then down from that is, but we're only going to invest in companies that meet these criteria. So it's great that exists, that these firms are out there making sure that there is more equal distribution of funds. And I think that's the right path. However, all the ones that I know still have that overriding, to get the investment dollars, you are seeking a path of investment that's going to give us that ROI. So for what I'm talking about, the way in which the venture ecosystem works, it's still the same even for those funds, just because they have that pressure to achieve those financial returns. The difference would be if there's things like family offices, meaning like it's a wealthy family who's decided to put some of their money into this particular cause area, or this. In that case, obviously, it's not outside investors, so they don't have that same pressure for a return on investment. And if there's mechanisms by which we can alleviate that stress, that kind of return on investment stress, both for the entrepreneur as well as for the funding agency, I do think that will help. Does that make sense?
Yeah, that's great. Thank you.
Yeah.
So can we talk about a little bit of what's the conversation going on in the chat here around the perception?
Oh, sorry, I'm not even in it.
That's all right. I'm filling you in on it because I know when you're presenting, it's hard to see what's going on here. Yeah. But just so, Alan, I don't know if you want to talk about what your experience was, but this common approach of if you present something that looks like the successful company line instead of the growth company line, there's a perception that either you're not thinking big enough or you're not VC scale, or whether or not the outcomes end up the same, how those narratives are perceived in the community, and kind of how are you going to get into that? Is that where we're going here a little bit, is kind of practical operational, yes, but also how that's communicated in a way that still communicates the bigger vision? Yeah,
really great question. I like that one a lot. Conceptually, what I'm saying is that, this line for successful companies that I see here is staying lean for as long as possible, meaning hopefully you're not trying to raise at the same rate these companies are. These are the ones that raise a lot of money and try to scale prematurely. And what happens is they are raising ahead of results as opposed to based on results. The successful companies don't raise as much and are patient with their dollars, and they have these fighting shape teams, these lean, disciplined, purposeful teams who can tell what's really going on in the market. And then when you're investing based on real results, then you can actually seek the bigger check because it's based in reality. I guess that's the difference. So The successful companies are raising less early on and not just saying, hey, we have to get an A round. And then the A round has to get these stats so we can get a B round, right? To me, that's the tail wagging the dog, right? If they're constantly saying, what will it take for us to raise an A? What will it take for us to raise a B? The reality is, what does the business need, right? What's the right thing for the business at this point in time? And I think that's what I'm trying to shine a light on with the stories that I tell in the book and a lot of the gotchas that I've seen. That if funding is really taking the priority, something's wrong. And oftentimes I see a lot of entrepreneurs putting what I'd call a golden paintbrush around, their presentation, making it look a lot more interesting than it is. And if they don't truly believe it, then I think that's when I would call it into question. Does that make sense?
Yeah, it does. We've been trying to approach a similar model, but working in the medical device sector, you have to raise some capital before you have any profitability. So
right.
Having revenue, having profitability, revenue, right? So having some capital pre-revenue, and then, obviously once you're getting to the point that you're profitable and defaults alive and all that, you have some options. But in that pre-revenue state, presenting a more credible approach that is not necessarily as bloated can sometimes mean there's some suspicion in the early days, even with angels, even with, very first checks about whether or not the big vision, the ambition is there for that trajectory. So that was more kind of where I was thinking about, but totally makes sense what you're describing in terms of staying lean once you're at that position where you have options.
That's exactly right. Yeah. And it sounds like from an intuition standpoint, you're doing that anyway, or that's how you're looking at it. So you're trying to raise as little as possible to prove out as much as possible. First and foremost to yourself, like you have to have conviction and believe that we're onto something big. And when that's the case, it's much easier to convince the investors. So if you can kind of see the sequence of chess moves, at least from a process standpoint, even if you don't understand them strategically, that will get you to be a breakout company. That's really helpful. And I think it's what I see a lot with founders is that they think in terms of funding rounds as a lazy shorthand to growth, as opposed to strategic, stages of true scale. Was there anything else from the chat? I'm sorry, go ahead.
I was just saying, well, we're told that, as I mentioned, as first-time startup founder, and I've had a lot of advice that basically says, okay, so start your first round and start planning for your next round before you finish your round. That's the advice I've been getting. I've been at this for 6 months, and somehow the ecosystem is feeding me this idea that I need to be in a continuous cycle of thinking of my next round of funding.
Yeah.
I don't know that it's necessarily that I want to be lazy. It's just like, it seems like, well, that's what we're supposed to do as startups.
Right. Yeah. And when I said lazy shorthand was, my term for a lot of these entrepreneurs. It's not the entrepreneur's fault. The ecosystem is telling you this. And so I'm trying to be a voice to say, the ecosystem has something at stake here. And there's a reason that you're hearing these things, right? Venture capital, in terms of funds invested, is over 20 times the amount that it was when I kind of started my entrepreneurial path in 1996. Are there that many more opportunities? No. I mean, technology's come a long way, and that makes sense. It does make sense for there to be some growth, but there is a massive, massive machine that is in place, and that machine is driven by a 1 out of 10 model to find these breakouts, and by running a pattern recognition based playbook that they see as the path to growth. And it does work in some of these cases, but I find a lot more interest in entrepreneurs seeing their dream come to life. And if they can be austere for longer and have that conviction and not fall prey to fancy people in fleece vests who tell you that, they can scale it.
A $3 million exit would change my life.
Right. Exactly. Exactly. And I think every business is different, and every business has its own destiny, and these businesses change dramatically over time with what they're capable of. So I think I'm trying to shed enough light on what do you do if you do go down this path and get stuck, and how do you transform it, but also through that process see, you know, what it looks like to be lean and disciplined and purposeful, and you know, and having that team that can get you to a much better place, and to do it on the right amount of capital and the right structure of that capital. So Brian, you had a question?
Yeah, so on this entire note of presenting an interesting path here, I've invested in many different companies, and it always ends up taking like an extra year beyond what the founders think. And for some of us, we knew that going in to our own businesses. And the problem is if you factor this in to your financial projections, then you don't stand out nearly as well versus some of the other companies. And so if you have realistic projections, instead of under promise and over deliver, instead, you just don't get the investment. I'm kind of struggling with exactly how optimistic to be in projections.
Yeah, and there's no formula, I guess, which is the point of a lot of what I'm saying. But I think to the extent you can go as long as possible for as lean as possible, prove out as much as possible, that's going to put you in a much better position. And the companies that just figure out how to make money, the ones that figure out how to get out of the gate with interesting metrics to get partners that are scrappy, are the ones that are in the driver's seat much later. So, like I saw this with Atlassian, who were friends of ours. We kind of started Jive at the same time as the Atlassian guys, and now it's a $50 billion company, and they owned most of it for many years. Or Qualtrics, which is another one that was bootstrapped for a long time. And so I don't know the answer, and every business again is different, so I can't prescribe it. But what I am saying is that there is machinery out there that's telling you a particular story, and that's not only the financial ecosystem and the people that represent that, but it's the media that takes the stories that are sexy and they know people are going to read, and that pushes those out. And it's this, to be quite honest, the peer groups. When you see someone who's in your peer group raise a bunch of money, then that makes you feel envious or insecure about what you're doing, right? I mean, we are so fueled by insecurity as entrepreneurs, right? There's so much to prove. Like, it's hard. The more enlightened of us maybe aren't, but I think for a lot of us, it can be hard to kind of fight the forces of this system that's telling you this is what success looks like, when the reality oftentimes is quite different.
So I see that Alexandra has her hand up.
Thank you, John. I have a question actually, because like you said, Dave, everybody has a different structure in their company. And so for my company, I feel without the investors, I can get to Series B, Series A on my own, bootstrapping, like you said, but it will take much longer than if I have brought investors on. Say, I can get to the same point in my business in 5 years bootstrapping, or I can get to the same place in 2 years with the investor involvement. So right now I'm trying to decide, do I want to go fast or I want to go slow? But it's pretty much the same path. So this is where I'm kind of hoping to gain some insight from you on whether, for me, which path to take, investor or non-investor.
Yeah. And by the way, John, I'm happy to send drafty version of this book to anybody who wants it. But the path is what I tried to lay out in this. And it goes from understanding what happened to get a company where it is today. And, if it's kind of in the situation where it's, stuck or not growing the way that they want, like what happened to get you there, all the way through building a growth plan. So to your question, the growth plan is very pragmatic, where it's kind of taking you through the process of doing the TAM, what you'd know as a TAM and SAM and SOM analysis to, understand the market opportunity, to look at a kind of top-down and bottoms-up approach to understanding what you can really legitimately pull off, and then looking at that as the basis for, should you just kind of stay on your current course and grow organically, Should you, grow, not in a VC 200% way, but maybe in a 50% growth year over year? And what does that path look like? Or do you really have conviction and, believe that you can grow this thing much more aggressively through a partner, in which case that's fine. There's nothing inherently good or bad necessarily about the investment, but I think doing it from a place of full awareness and conviction of what your growth opportunity really looks like, such that you don't end up in that position of being stuck and having very little options and having to sell the company off where the investors are the ones who get paid for it. So all that to say is, I don't know the answer to the question, but the book does kind of go through systematically and say, here's how you figure out what the right growth path looks like. And here's how I come up with a plan that I believe strongly in. And then for each plan, there are all kinds of different investment dollars that are out there, right? There are family offices, there are bank loans, there's friends and family, there are different kinds of private equity firms that are out there. There's bridge financing. It's just, the world is awash in different, mechanisms for getting companies financed. And the biggest premise would be, is it truly based on your belief and conviction? Or are you just kind of assuming that raising venture is going to solve a lot of these other problems once you have that money?
Good point. Thank you.
I think it might be industry specific too. If you have too many competitors, I think it's better to raise money. That's my opinion.
Yeah. Again, everything's different.
Yeah.
So this book, sorry, what?
I have a quick question. So based on extension of the previous question, it's like when you call a company as a venture based, so venture capitalists have their own calculations, right? Hey, if they reach $100 million in certain number of years. So is there any template for like financial projections perspective for a venture based company that, hey, you have to reach 100 million in like 3 years from now, or maybe 10 years from now? So is there any template that they look for out of a company, out of a startup that's trying to fundraise?
I mean, every firm will probably have a different version of that template, but by and large, these venture firms will be looking to make a 10x return. They would hope that you're a company where they can make a 10x return. It's going to be high risk around that, but that's what they're looking for. Private equity is looking for more of a consistent 3 to 5x return. And so they're looking at companies that are much more mature, probably growing at 50% a year, not 200% a year, right? So a VC may say, like, they have this thing they call like triple, double, double, right? That's an example of the lazy shorthand I'm talking about, where if this is a company that triples a couple of years in a row and then doubles 3 years in a row, then it's on a path to go public, right? So these are some of the things that they talk about and the growth rates that they're looking for. And that's really hard to do, to do that level of growth, right? So you have to say, do I fully believe that my company can do that level of growth? Do I fully believe that we're aligned, you VC and me entrepreneur, in this path? Or am I selling my soul for 200% growth and, I'm going to die on the field trying to get that, but it's not going to work. And, there could have been another path that is right for the business.
All right, cool. Thank you, Dave.
Yeah. And by the way, I have a lot of Seattle companies in the book too, for what it's worth. Anybody know Simply Measured, Adam? Or
Absolutely.
So yeah, so Adam's great. I really enjoy him. And so I was an early investor, a seed investor in Simply Measured way back when. And so in the book, we tell the story of, how great things were. Like, they were classic entrepreneurs, built it, started with a spreadsheet that they were selling to people, and then, just built on top of what they were doing, and they loved it and they were really good at it, and they had a really good market. And so they raised, $5 million and were doing really well. And then someone came with a $20 million check, and they took the $20 million check, and suddenly 5 salespeople to 20 salespeople, things started to shake, and they were forced to try and identify bigger markets. And, their core wasn't applicable to those markets, and the competition was much too fierce. And so the headwinds were dramatic. And then Adam got pushed out as CEO. They brought somebody else in, but at that point it was too late, and they had raised too much money, and it was just a rescue job. And it, was sold in a transaction that didn't do well for any of us. And so Adam and I had great conversations about this, like what went wrong. And it was that same idea of, you know, the entrepreneur is being told, you can keep growing this, you can keep scaling, and they believe that, and you want to. We as entrepreneurs are very, you know, receptive to positive information, and very excited about what we can do in the future. But there has to be a level of pragmatism around, you know, what growth really looks like before you just take that check. And so this was an example of a company that got stuck, and we talk about why and ultimately what happened to it. In Adam's next company, he bootstrapped it and just ran it very differently, and I think has a very different approach now. And I saw that with a lot of the entrepreneurs I worked with, which was, you know, the first time around, they had to make a lot of these mistakes, but the more experienced entrepreneurs were more proud about how little money they'd raised than how much money they'd raised. Early entrepreneurs very excited about, like, hey, I raised this much money, right? That's really exciting. But experienced entrepreneurs are like, we got to this on only this much of investment, right? Which becomes more of an interesting talking point. So my thing is that, you know, our companies aren't going to transform until we transform. And so as a founder, I certainly had to do this. There are a lot of blind spots that we have. And those blind spots stem from levels of insecurity. They come from childhood. They come from everything else. All these things that cause us to make certain decisions that may not be in our best interest over time. And if we don't confront those demons, and this will kind of maybe sound a little hippy-dippy, but I promise it's not, which is we have to transform as a leader before we can transform our company and before we can grow the business that we really want. And so this chapter talks about the things that I certainly ran into, where I was massively insecure and just trying to prove myself out there, and all the decisions that I made that ultimately led to Jive's long-term demise, because I brought in the people I thought were the right people, because I did the things I thought were the right things to do, but they weren't based on intuition, and they weren't based on conviction. They were based on what I was being told to do. And so while we have all of these amazing qualities to make something out of nothing, and to have unbridled enthusiasm and energy, and to work long hours for what we believe in, there's also a dark side of being an entrepreneur, of you know, having more fragile egos and needing to prove ourselves. And so this is a chapter for what it really means to go through and identify what are our strengths and what are our weaknesses, and to identify what that turns into for us as a leader. Because often for these companies that get stuck or are on the path to getting stuck and not getting the breakout that they need, it's because we have these patterns that we keep repeating and that we haven't confronted. So again, remember, this is a turnaround book of sorts, right? This is a book of transforming stuck startups. So to do that, you have to confront your leadership style, and you have to confront the issues that you're facing. And here's another Seattle quote. I tried to get as much Seattle in here as I could. Do you guys know Kirby? I'm sure a lot of you do, because he's very much into that world. So hey, yes. Really enjoy Kirby. He's just a great person, and kind of talked about how he was as an entrepreneurial leader in the early days for his companies, and how he was so driven and so what he called on tilt, that he pushed these companies' growth at all costs, but that he failed to see a lot of the kind of strategic things that were happening in the market, and he was late to the game. And so he saw all these failures and mistakes that he made until he kind of got past that just burn the candle at both ends, work philosophy, and to transform himself into something much better. And that made him a better leader. And, you know, I saw that happen for myself as well. Once I kind of got out of my own way, and with the business, it was not an extension of me, but I was just a steward for the business. You know, the more invisible I could be, the better. The more I could support other people, customers, employees, investors, like, and I'm just a steward for them doing well, then things started to change pretty dramatically. So the first step was, you know, assess what happened, why you got stuck. And then this next stage is really about, well, what's underlying you getting stuck? What are the patterns that you see in your own mind and your own blind spots that were leading to, this stasis that you're seeing. You're not getting the growth that you need, or not fulfilling your destiny as a business or as an entrepreneur.
So one of the things that is would be interesting at some point is to hear you're an LP in Kirby's fund. So there's a journey there for Kirby moving from entrepreneurship to investing. You've also followed that journey. So that'd be good to hear about, but maybe now is not the right time given your slide.
Yeah, I mean, the one comment I would make is that I tend to work with people that I really like. And from an investment standpoint as well. Do I feel like I have something to offer? Do I feel like I really believe in this person at their core? Do I enjoy them? And in which case, a lot of times as an investor, I also am a coach and mentor where I can be. And that's much more fun for me than just blindly investing in the companies. And I think Kirby and I had a very similar perspective on a lot of these things. And so I was anxious to be a part of his journey as well. So the third step is what I call reorganizing around your core. And this is, a lot of companies that I've worked with are really good at one thing, but they invest in all these areas. And there's this kind of peanut butter perspective over the whole business where they cease to see their magic. They cease to see, again, for Warren, the beachhead, or the thing that they are really, really great at, the market where they are the best in the world. That's gotten lost in the pursuit of growth as the primary mechanism for success in the business. And so the core has gotten hidden or confused with a lot of different trajectories. Hey, we can also sell to this market and this market, or, let's also develop this thing in parallel, and that'll get us our growth rate on track. And in reality, what's happening is companies are building confusing messes. They're not what's going to hinder velocity later as a business, because you have too many different threads. You have salespeople selling to too many different buyers, products that are confusing, markets that need different types of things from you, a brand that's getting confused along the way. So what I do in a lot of these businesses is say, okay, stop all just do this. That's the thing that you're really good at. Mobilize, the one I talked about before that I'm doing right now, they had literally 24 hours left to live. And so if I can turn this company around, anybody can turn around a company. And they had gotten stuck because they were trying to please everybody. They were trying to just grow for the sake of the VC investors. But they were trying to accommodate way too many use cases. It was community software. And what I realized was, you're good at this thing over here, which is professional networks, membership networks. So anytime there's a membership community, like a trade association or like a private label LinkedIn, that's what you should do. And everything else goes away. And that's what we did, just focused on that core. So the first step in that transformation process is to really understand what you are the best in the world at, and then get the company profitable, get the company to a point of sustainability so that you've got time and space to run experiments for what growth should look like. But you're not under huge amounts of pressure as you're running those experiments. It's that pressure that causes poor decisions to be made. So this is what I see a lot of times is, the core business, again, hidden by these other areas, which are, you've got areas that may be profitable in some of these businesses. By the way, some of these businesses are a little larger. So as typical seed stage startups, this may not resonate, but for, like B round, C round startup companies that are at growth stage, what they may have are these other activities they're doing that may look profitable from the outside or register as profitable on P&L, but ultimately are so distracting. They're creating a two-headed monster where everything in the business is, well, is it this business or this business? And that just slows everything down. And if you have more than two, it gets even worse. Beyond that, you have these businesses that are these cool experiments that maybe the CEO loves because of what it represents, but they're just not profitable. They're confusing, they're distracting, the company's not aligned on it, and ultimately it's getting in the way of building the business. And then finally, there's these experiments that companies run. So this is what I see when I come into these businesses. And in this chapter, another Seattle business that I have from a long time ago, this is back in the .com heyday, a company called QPass that had raised $90 million on path to an IPO with $6 million in revenue. This is, you can tell it's part of the .com collapse, and 3.5 of that revenue was from one customer, the Wall Street Journal. So they were going public on basically a bunch of people experimenting with this new technology for doing digital transactions. And Chase, you know, to his credit, like kind of stripped it down and said, what is the one thing that we're good at? And it was this digital transactions. And as opposed to just facilitating them on the web for customers that were paying, they built out infrastructure for doing digital transactions and sold it to the wireless providers. And interestingly enough, this is back when ringtones were first a thing. So when people were buying ringtones, it was the first time they were doing these micro transactions. And so they, you know, had to completely recapitalize the business, build it from ground up with that core of, we understand microtransactions, and applying it to a totally different market in a totally different way. And ultimately they were sold for $300 million several years later. So it was a great transformation story that was all about what is our core, what is our essence as a business, and how do we start with that and then grow, as opposed to trying to force growth in ways that that don't make sense. I'll stop again. Questions?
Yeah. Do you think this is something you can bake in from the beginning and not drift from your core? Or do you think this is something that over time companies may find that what they originally thought was their core isn't actually where they should be? And so some experimentation is good, but at some point you have to say, okay, now we're stopping? Or do you think anytime people are drifting, they're going to end, the risks are too high?
Really good question. And, you know, for me as an entrepreneur, what I typically do, and I'll talk about this in one of the slides if we get to it, is try to organize everybody in the company, with the exception of just a few people, really tightly around that core so that you get better and better and better at that. And what I do is separate the strategic experiment, this part over here, so as not to distract the team. Because what'll happen is if everybody's involved in this, it's like, well, we could do this, and what if we did this, right? It gets really confusing for the team. So as CEO, what I try to do is keep most everybody doing this really well and getting better and better and better at that. So that you're building a name for yourself, and that you are really tightening your value proposition and just getting really good at that core market. And myself and maybe one other person or advisors, that sort of thing, will kind of be off doing this experimentation of trying out different things. For example, I spent the last year at Mobilize, every quarter I would do 50 customer interviews on a different strategic idea. And the team knew I was doing something, but I shared very little with them because I didn't want to confuse them. And each quarter was a different idea. And by the end of that quarter, I'd be like, well, here's what's good about it. Here's what's not good. Here's what I think the risks are. I think this is a better thing to investigate. And so I literally ran 4 experiments over the course of the year. Ultimately, one is the one that we're now doing a much deeper dive as the basis for our expansion. But I tried to keep it separate, if that makes sense. So there was a clear line between the experimentation around growth strategies and just being really good at our core business. Does that answer your question, Caitlin?
Yeah, I really appreciate that. And that makes sense in the context of this. So thanks.
Great.
I see a question from Alexandra.
Yeah. Sorry, I can't see all the things.
Gotcha. So yes, you did mention about how our past experiences affect our present abilities as leaders. And I was wondering about if the companies are having a hard time moving up with larger investors present because they've been bootstrapping for too long. Like, I have very good experience bootstrapping, but can I move on if I have more? Do you have, did you discover any tools in how to move from one mentality to the other? Because you said you need to work out on your ghosts of the past, basically.
Yeah, such a good question. I had to go through that myself, and it was hard. And I think the thing I didn't do well was pick investors that I thought could help me along that path. I think one of the best things that I could have done would have been to find investors that I thought could help me with that growth and movement towards being the CEO that the company needed at that stage. And also maybe an executive coach who had helped with that path as well. So I would have, in an ideal world, sought investors that I really believed in their values and their history and experience as one that could help me, and also supplement that with other advisors and coaches who could help that growth path as well. And I didn't really have that, but it is a pretty profound change that you need to go through. And I think for all of us, it may look different. You know, in my case, for example, I had been a management consultant for a lot of my career. So I was very good at being an analyst and very good at being a facilitator. But being a leader of a company scale means you need to be, you know, intuitive and gut driven and you know, decisive and you know, it starts to look pretty different. And those weren't skills that I had. And I really had to learn them on the job without a lot of help. So yeah, I know there's not a perfect answer there, but I think for me, that's what would have helped a lot more. If ultimately I did decide, yeah, let's take a big round and let's go operate at this scale. I'm dealing with a CEO that I coach now who just raised a big round. And he's like, what do I do at this stage? And so we're finding him a coach. And he's also joining a CEO group. And, you know, I think the investors that we brought on are probably also pretty good because they see this a lot.
You said joining the CEO group. What do you mean by that? You have, as an investor, you have a CEO group that you brought your company in, that you just invested in?
No, I think there's a lot of different groups like YPO or I can't remember the name of the one that he joined, but it's just a peer group of other CEOs who are at similar stages of company. And so you can have people that you can have a frank and confidential conversation with and say, hey, I'm dealing with this. Like, do you guys have stories? Have you dealt with similar things? And so I think having that ability to be vulnerable among peers is a really valuable thing if you can find it. And people who are completely separate from the business where they have no stake. And so you can be more open about what's really going on.
Sounds like a group therapy for entrepreneurs. Where do we find them?
Again, I did one for a while called YPO, which is Young Presidents Organization. There's also one called EO, which is Entrepreneurs Organization for smaller companies that do these things called forum groups, where they have people like 6 to 8 people in a group. And I think there's a lot of others out there now too. I'm forgetting the names offhand. Seattle may have its own version of that, but there's such a need. Like, you know, we don't talk about the mental stress that this puts on us and, you know, how hard it can be to be the leader and you have to make the decisions. Everybody's looking at you and all this pressure. And we wake up in the middle of the night freaking out about these things. Like, it puts a lot of pressure on us and by extension, our families. And so finding some relief valve for that pressure is critical. And I think oftentimes that can be done well through other people who are feeling the same pain.
Hard to explain to your mother what you're going through as a CEO.
Yeah, pretty much.
Yeah, we have a bunch of them around. Elizabeth just put the life sciences one in. Vistage is another example of one of them.
Vistage, well. Yeah, that's right. Yes. Others too. I've heard about a bunch of them recently, and I think the increase in conversation about mental health has been helpful in this regard. And it's not just the mental health part of it; it's just the day-to-day too. So having these groups of people who can be sounding boards are super important. I personally have what I call a personal board of directors, which is people who know me intimately, and when I have to make a decision, life or business, they know I can go to them.
Right. This is one of the benefits of being part of a Techstars cohort, is their founder network ends up forming these sort of naturally. You start ending up with these little peer learning groups of people been through the same grinder that you're going through.
Yep. And by the way, if I don't make it through all these slides, it really doesn't matter. Again, all these slides came through this morning. I just want you to like what I'm talking about is this process for transformation. But really, your questions are much more interesting than the stuff that I'm talking about. So feel free to stop whenever. And I can't see everybody's hand or I can't see the chat. So John, maybe just tell me if there's somebody who wants to ask a question or if there's a conversation to be had.
Yeah, it's in the participants component, and there are no hands up now, but I will tell you when people put their hands
Okay, great. So we talked about streamlining around the core and then you putting yourself in a position where you can experiment, right? So the streamlining is oftentimes these companies that had gotten raised and they tried to scale prematurely, they've gotten bloated. My path is to get them refocused on their core. What are you the best in the world at? And that does mean letting go of people. Usually, it does mean cutting a lot of costs. It does mean getting hyper focused on goals that are aligned with what that core business is. Because when you do that and the business is in a healthy position, it gives you that best scenario, time, space, patience, thoughtfulness to start experimenting around what does represent your growth potential. And companies that go too fast towards their breakout often fail. Most of the time fail. I mean, most businesses, if you actually go back and look at them, even if it happened fairly quickly, they started out doing one thing really, really well. Amazon and books, or Google with their, index search engine way back in the day, Facebook at Harvard, all these big companies started out doing one tiny little thing and they do it really well. And that was how they built that reputation and recognition. And that can get lost in the early stages of a startup where we have investors who are trying to scale businesses really aggressively and oftentimes prematurely. So what I do when I come in is to really streamline, help them understand what is your core business. And when you go through that process, you have to let go of people and you kind of reestablish the business. These are some of the keys that I find is just set goals that people know that are achievable. They're not super aggressive, but achievable so that you can get people feeling like we're winning, that the scoreboard is in our favor. You keep celebrating the company. You're building people who are doing things. You're giving out gifts to people when they do things that are great. An openness and transparency around what you're doing, and try to add lightness to the journey, especially if you've had to let go of people or admit to it didn't work in the last phase, but this is what we know works, and then people can see that think we're hitting the metrics, we're doing the things we said we would do. That gives the company momentum. So kind of get the company reestablished and get it healthy and getting people excited about what they're doing again. And then, as I mentioned before, in ways that don't distract the rest of the company, start to look at ways to take the company into growth directions. So have a very small team of people who are focused on a breakout strategy, go deep into the data, go through experiments and test this, like what I did last year, doing 50 interviews every quarter with different people to figure out the growth path. And either you find the thing and you prove it out beyond a shadow of a doubt that this thing really does work and does have legs, or you don't, and you can wait and you could keep trying, and that's okay. Or ultimately you may decide that this is maybe there isn't a breakout path here. Maybe this is a smaller business that grows at 50% a year, and that's fine. And if we don't raise more money, we don't get diluted, and we can make really do really well. As was it Eileen, forgive me if I'm getting your name wrong, so $3 million business would be life-changing money, right? Like there could be a really healthy business in there, and the money is just going to get in the way of figuring out what that is. So all that to say is, it's much better to get past the attempted growth that didn't work and go back down to here's what we know we're the best in the world at, and then thoughtfully experiment with different ways to take that core, to take the thing that you're really great at, but apply it to a larger market where there is higher growth rates. Any questions on that?
So down in the middle, you're using this word be lean, which we use in a bunch of different ways. And you talk about being at the core. And I keep typing in the chat, be cash flow positive. And Caitlin keeps saying, I'm doing this med tech thing, so I can't be cash flow positive. So stop talking about it kind of feeling. And so I'm picking on you, I know, Caitlin, but the process of being focused on a thing that is the right size for what you are now is part of that. Be productive, which is what I think you mean when you say lean, right? Given the resources I have, be very productive with the resources I have, right? Which means taking on projects that are the size of the resources I have. Is that,
right?
Am I reading you
That's right.
correctly?
Yeah, it's a small driven team who can be really capable within the sphere that they play, within their sandbox, right?
Yeah.
And that's the fighting shape element of it is don't hire people because VCs told you need to hire more people to grow. Don't, hire people just because, and then the types of people that you bring on, make sure that these are people who are what I call good-natured ass kickers. Like they've got the drive and the chutzpah and, the collaborative, good-natured elements that they feel like they're part of this journey with you. And that small group of dedicated individuals can make a huge impact as opposed to, a larger group of people who are just doing a job. So that's the essence of the fighting shape idea, is that if you are, it doesn't have to be profitable, but at least if you have time and space to experiment around the right way to grow, as opposed to just having assumptions that you think, well, this is what we're going to do, we're just going to keep executing on it. That to me is when I see the breakout companies really happen. And for some companies that can happen in a short period of time, for some it may take years. Like it took us 5 years at Jive, right? But we were bootstrapped, so we had that 5 years to do it. And we never would have figured that out had we had investment early on.
A lot of people don't translate bootstrap to cash flow positive. They translate to bootstrap of doing what I can with what I've got, and then they keep feeding the beast. And so when you say bootstrap, do you mean I'm a cash flow positive, profitable company doing something, maybe small margin, but I have margin and I'm growing?
Yeah, bootstrapping to me means, you're taking very little investment and you are proving out what you need to prove out on a shoestring budget, or you are proving it out because customers are paying you to prove it out. So it's non-dilutive financing, right? So I know, a lot of entrepreneurs who sign a deal with a partner and the partner becomes the first vendor to use this solution. And that partner is going to pay them $2 million over 2 years to be first or whatever it is. And so that's a creative way to bootstrap a business where you don't have to sell out or have, people breathing down your neck for certain outcomes. Now, is that the right call? I don't know. It depends on the business, but there are creative ways to be smart about the amount and nature of capital that you bring into the company that don't force a growth at all costs mentality.
So John, since you brought me into the ring, I will say I completely agree that this is the way that medtech companies need to be built. And actually, because of how medtech works, if you don't take this approach, you end up raising too much money that when it comes to having what would be a great exit for all of the initial players, you took on additional capital. Now those options are not available anymore. And so now you actually are in reducing that optionality actually creates exactly the situation David's been describing. So I think the point I was just making is even if you're not at the point where you have revenue, you can still take this principle to the way you build the business to get to cash flow positive, default to live as soon as possible. And that actually positions you to survive a lot better and then decide where it makes sense to take on the growth capital.
Right. I'm just trying to sort of put the bounds on the words that we're using a little bit. Because a lot of times people mean bootstrapped as, 3 people in the garage, starving, not making money for 5 years until magic happens. And that's not what Dave means either. And so, we're talking about a real business that does real things, that creates real value for someone. And the founders are being paid along the way here in the bootstrapping thing. Maybe ramen profitable paid, but it's a survivable business, not a donation to a dream.
Right. Yeah, exactly. Yeah, and Caitlin said it better than I would have, but I like that idea. Be good at something and give yourself the time and space to figure out the right path, as opposed to, assuming that things are going to keep working out. And I'm going to jump to this because we keep talking about it, which is the growth plan that I talk about. How do you build a growth plan, and going through all of these things so you understand deeply at your core, like, what's the real potential of this business, both short, medium, and long term, and how would that change, based on the amount of money that we have, and going pretty deep on that, but saying ultimately you may not find a breakout path. Maybe you do have to stay in a $20 million market, and that's okay. But if you're the best at that $20 million market and you can build a really healthy business from it, you could do really well on that. A lot of people could. That's life-changing money if you don't have to raise tons of venture capital for it. And if you did raise tons of venture capital, you wouldn't see a dime, because you'd never be able to get out of that market. And so I do spend time talking about, what does this process look like to have a growth path that you have conviction in? And it does lead to, one of three options. Basically, you can stay the course, which is, let's just keep growing our business organically within the sandbox that we play in now. And if that's our path, there may be various ways to finance that aren't traditional venture or private equity. We can expand thoughtfully. We could grow into new markets kind of one at a time, and not try to seek that 200% doubling growth that we're getting on VC, but let's kind of, we sell to this vertical market today. It's pretty cool. And again, for the crossing the chasm person on board, I think maybe this is equivalent to the bowling pin strategy, or I don't know, you can comment on it, but that idea of, like, there are adjacent markets that can be natural extensions of what we're doing, that we can add to that, and we can keep our growth rate going and not have to kind of say, okay, now we went from a $10 million market to $1 billion market overnight because we added certain features. That's just not realistic. So expanding thoughtfully means, okay, maybe we're going for that 50 or 60% growth, and we're going to do it, by taking on different markets and adjacencies over time, which may have, again, a different set of financial options available to it. And then there's the third option of, yeah, we're really onto something, and we believe it, and we know that we can execute on it, and we've got proof points, right? We've actually already got customers in these three target verticals that we're going to go after, and all these customers need the same thing, and this is really working, and we cracked the code on it, and we're significantly differentiated from other vendors in the space. So I definitely want to take venture because we believe firmly in this, and we want to go big. Great, it's a good place to be, but at least you're doing it with an eyes wide open perspective at that point.
And more importantly, you're doing it with the core business engine functioning. And so you're expanding something that you know is working, rather than pretending you're going to build something that will be functioning.
Yeah, exactly. Based on results instead of ahead of results. And there's a lot of creative ways to do it. So Commerce IQ, the company down here, which has a big office in Seattle, ostensibly based down here, but I'm on their board. I've been on their board for a long time. This was a company that it was originally called Boomerang Commerce, and sold software to retailers. And they built out a good, healthy $12 million business selling to retailers. And then Amazon, another Seattle business, came and changed the retail environment in a substantial way. And a lot of the customers that they were selling their price optimization software to died on the vine. And so they were like, what do we do? We have to go in a completely different direction. And so they had this healthy $12 million business. And instead of just trying to say, that's our future, let's stick with that core, they took the technology core that they had, which is this kind of data analysis they did, and built a new product to apply it to a different market, which was brands. So brands have the potential to be successful in the Amazon world that we live in today, because they have a unique product, they have a unique story, and that's defensible. So if you can help brands sell their products on Amazon and other markets, that's a much better way to apply this technology. So what they did was packaged up their whole retail business, the software business, and they sold it. They ended up selling it to one of their customers and put, $45 million in the bank, and used that money to build out this whole new business. And they beat their revenue from the old business in a matter of several years. and they just raised money at a huge valuation because they had a $12 million business now selling to a different market. So in that case, that was an asset sale. They sold one part of the business that was dying, and they recognized what it was to finance growth of this whole new business. And now they've transformed into something else entirely. And it's been really fun to watch that. So, you know, again, all the businesses are different, but it's, you know, looking creatively at the different funding options that are out there and available to you, and being very purposeful and disciplined about the approach of understanding what your true growth plan really is, what it really looks like, and what the options are, and not just doing it for the sake of trying to bring cash in by whatever means possible. I don't know how I'm doing on time, by the way. Again, I can't see anything. I just see my slides, so my apologies.
We have 2 hours set aside, and we're an hour and a half in. This would be a good point for us to drop into conversation if people have conversations.
Let's do that.
We've lost 40% of the group because they think that they're supposed to work at 1 o'clock, but the rest of us are here working on it. Anybody have any points they want to bring up? Alicia, you had something you said in the chat. Did that get addressed?
Well, you had said that over optimization or early optimization can be fatal to startups, and I was just wondering if you could elaborate on that.
Yeah, premature optimization can be fatal to startups. Yeah.
Premature scaling. Yeah.
Oh, okay. Thank you.
Or premature scaling, or designing for the perfect solution. All forms of different perfection things get you in trouble.
Yeah, what I see happen a lot of times is people using, you know, a certain set of data points as justification for larger growth, you know, without kind of really understanding the connective tissue between where they are today and that future state ideal. And so they, you know, take a few of those data points and oversample them and, you know, start trying to replicate what they've done without really having that deep sense of what's required to hit that scale. So, yeah, I think it was the Startup Genome project, you know, kind of dug deep on that. And so that's the #1 failure of most startups, is scaling prematurely.
Any other thoughts people have? Alexandra, you're unmuted. Do you want to say something, have a comment?
I wanted to make sure David said that these slides are available in his book.
Yeah, when it finally gets out. So as I mentioned before, you know, the last chapter of the book is the company that I'm doing now, which is a classic example. I did raise venture for it because, you know, we barely had any revenue. And then I told the venture investors, like, hey, I'm either going to find a breakout or I'm going to take it profitable. And as of this week, couldn't get the venture growth, but what I'm doing is acquiring the business back and putting it under another business of mine and getting it healthy and profitable. So I was left with the fighting shape team, and I love these guys and I want to keep doing this thing. And so I'm actually buying the business back, even though the investors will come along for the ride, and giving it the time and space with a lean team and make it cash flow to get to that breakout. So I've actually gone through the whole process, all the bad mistakes and ultimately the right resolution. And I'm at the end of that process. So when I write the chapter on Mobilize, that's when I'll be the kind of capstone to this book, and I'll try to get it out by end of year. That's my goal. So yeah, the book's written. It's just in really ugly Word documents right now with a lot of editorial comments on it.
So there were a lot of people that were happy to take a draft. If you put it in a place where I can access it, I'll share with people who attended.
Yeah, I would love all your feedback on it too. That would be great, because again, this is really rough.
So David, do you see the craziness of the VC ecosystem course correcting in some way, that, or do you anticipate just a big painful fallout?
Both. Course correcting through painful fallout.
Or your book, right?
Yeah, I know. I have to time it with the fallout so people can go, okay, are you stuck? Good.
Oh, you're so smart.
But I got entrepreneur the other day, is a friend of mine. They are pre-revenue, and he said someone was talking to them about a 300 million pre, and I was like, "This is bonkers." You're right. I was talking about like I raised at Jive. We raised 15 million on 12 million of profitable revenue at a 50 million pre, and now like I have people talking to me about that. Like it's just normal now. These entrepreneurs are saying, "Well, if we get 80 million," I'm like, "Well, what's your revenue? 20K." Well, 20K a month, I could maybe see that. I know 20K annually. I'm like, oh my God.
Yeah, so this is sounding a whole lot like .com era, right? I was living through that time, and it was all about clicks and eyeballs and incredible valuations for that era. And
yeah.
So we're kind of in a repeat of that. I wanted to make a comment that maybe it's my own experience, which has been getting burned by investors. But I am allergic to venture capital investment. And so I'm really, really focusing on building customers, building revenue, getting cash flow positive. I want to take money from angel investors that have experience in my industry who can actually help me get traction. And I'm laser focused on just finding those compelling 1 or 2 use cases and just get really narrow and really, really good at that. I totally get I'm myopic. In fact, I'm investing in my myopathy. Anyway, I'm investing in
myopia.
Thank you. Because I think that it's the only path I know that I can control. If I can get cash flow positive, I can really focus the team. I'm in control of the company. As soon as I go out and make big promises, like somebody was saying earlier, show that hockey stick curve that will convince everybody that we're the next unicorn. If I buy into that whole thing, I'm lost.
Yeah, totally agree. I love that. In fact, the investor that was quoted on that last slide about kind of the growth plan is a woman who's got a firm down here, and her father had started 6 businesses, and all of them are still running, and only 1 took venture capital.
And I bet it's not running.
yeah, probably running in a very different way. But so yeah, I think that's good. I think it's healthy, and I don't have any issue with venture capital at all. I think structurally it's fine. It makes sense. People need it. I just think the current state of venture capital is not doing the best job by the entrepreneurs that it seeks to serve.
Yeah, I mean, there's good VCs out there. They're not all bad people. It's just that it does cause you to shift your priorities. And I really agree. I'm looking forward to reading your book.
Great. Well, thank you guys so much for listening to it. I know it's a little rough in terms of the slides, but it's content that I'm super passionate about. And honestly, I wrote it for entrepreneurs. If I can help any entrepreneur out there, with their own path, and it was meaningful to me. If I can use all the dumb things that I did in my history and share those with other people and help them make the right decisions, then that's what matters. So it was a passion project, and hopefully it's useful to people.
Cool.
But I appreciate your listening today for sure. And I'll try to clean up, basically, because right now it's a bunch of red lines chapters. I'll try to clean them up and just put them in a Dropbox folder and share that with you, John, and you can share it out with the group.
That'll be great. I'll be glad to do it. I see Brian has his hand up, but I also heard somebody trying to say something.
Brian.
Go ahead, Alexandra.
I'm just gonna wait for Brian, but so it sounds like you encourage and everybody. It just sounds like for the founders to be very precise, very detailed on the interview with the investors. So it's like it's a two-way process, right? So founders seeking money, they're asking for it, so they may be reluctant to say, "I'm not quite sure what I'm doing," or it just sounds like you encouraging founders to be very picky also about who they bring in as an investor to their company. It's a new approach. It sounds like it's a new approach, right? So it's not something that was really done in the past by those who already have experience bringing on investors.
Yeah, that's a good way to put it. I think the fighting shape philosophy will hopefully give you the time and space to make your company really valuable, such that when you do get into those investor conversations, you're in the driver's seat. You're not coming and begging for money and saying, hey, can we have this? Because I think we can do this thing over here. You're saying, no, we did this thing and we are doing this thing. And if you want to be part of the ride, you know, then show me what you got. It's a very different position to be in.
Do you think investors are open to this new set of thought? It's how would the investors respond to that? Or like, because there's a lot of investors present here at this group. And so do you think that is possible to shift mentality for the investors as well?
I think so. I think investors are much more interested in seeing companies that are actually proven companies that have real metrics behind them, that have an entrepreneur who knows how to be lean and fight for what they care about. Like, that's much more interesting to an investor. And I, as an investor, love to see that. You know, if I invest in a company that has been lean and sinewy and just kind of, you know, fighting it out for a couple of years, and they built $2 million of revenue just by, you know, being bulldogged, and they finally kind of are ready to start scaling this thing. That's much more interesting to me than, you know, an entrepreneur who's coming and saying, we want to, you know, take on the new marketing automation system. We want to own that market or something, right? Which is like, there's 1,000 companies there and you haven't proven anything and it's just a dream. And so, I don't know, I would hope that investors would be much more interested in that, at least good ones.
They are, in fact, typically interested in seeing, when they use the magic word traction, what they really mean is they want to see the business engine running. And that business engine is exactly what David just talked about. And so I don't think there's a mind shift that needs to happen. I think it's a engagement in the business engine that needs to be clear. Anyway, Brian had his hand up.
Yeah, thank you for bringing up all of the focus here on growing too fast. I've chatted with other companies where, you know, I've heard that the company just plain grew too fast for their market. And yet I've been in probably 300 different pitch meetings, if not more, from as an investor. And not once do I think I've ever heard any investor bring up a fear about a company growing too fast. Now, granted, this is mostly angel investors I participated with, not VCs, but I think there's a huge lack of awareness of this potential problem, at least in the investor community, if not also with entrepreneurs. So I think your book really could fill a big void out there.
Good. Well, thank you. Yeah. I do see it happening all the time. And, you know, it's maybe not necessarily growing fast as it is trying to grow too fast and killing everything in the process. You know, that's what I see.
Any other thoughts from anyone?
Question on that. So I've been listening about bootstrapping, grow too fast. But do you think Amazon would never be Amazon if they employ this strategy? Like, do you think it's kind of limiting belief that you put on yourself?
Well, again, I'm not talking about bootstrapping versus VC. I think VC is great for the businesses that need it. And Amazon actually raised very little VC in the early days. So if you actually go and look, they raised a surprisingly small amount for where they got to. And again, VC is great for the companies that are capable of growing in the way that they want. Definitely do it. It's the right thing. It would be irresponsible not to do it. What I see, though, is that, you know, it's the other 9 companies that raise VC that either could have been smarter, either should have been in the business in the first place, or could have been smarter about the way that they brought on capital. So Jeff Bezos was brilliant. He didn't bring on that much at all. And they got to large scale on a small amount of money.
Alicia has her hand up.
So then what would be these telltale signs that you're one of the 9 and not the 1?
That's what the book's about. Yeah. And you may not be, but I think the book is really just like you're going in eyes wide open, that you know what business this should be. So, you know, if you are believing that you're the 1 out of 10, if you are capable of growing, you know, 10 times or at 200% a year, that, you know, going into this, that I believe, I have conviction this could work because I have data points in support of it. And, we've got a plan that is based in reality. So it's not a dream that I'm raising that money on. It's based on actual data points and, a supporting market and growth plan that makes sense. And if we don't believe it, there's different financing that we can do to support the growth of a business and not get as much dilution and not suffer the pressure of forced growth.
Cool. Any other thoughts on anybody's part? Caitlin, I'll let you have the last word.
Well, then, John, I actually wanted to ask you, hearing all of this and how this fits in with. Oh,
You became Daft Punk.
Is that better?
No,
you can tell.
Say it again and I'll read between the burps. Oh, how does this fit into SAC? Well, our goal is to create new angel investors. And so our goal is to get people to invest in things that work in a smart way. And at least at the foundation for my beliefs, angel investing, that is that little corner before VC, is not the only place that angel investing can be. And so if you look at the terms and you look at how people structure what they're doing, there should be a much, much wider opportunity for local angel investors to invest in local businesses. So if you build a real business engine and you've done real customer discovery and you take the right terms, then I believe that angel investors, that is individuals that are putting risk capital into your business at the hope of reasonable risk adjusted return, should be able to invest in you. And I'm right along with Looney Libs that thinks this is a large number of the companies if you use revenue redemption or something like that. But it's pretty easy for companies or for angel investors that are following behind the journey that David went through to get screwed by the Series C and Series D venture people. And so there's a certain number of angels who are like wanting to invest in one and done deals where I'm going to give you the money, but this is the only money you're going to take. And we can see where you're going to get to, and then you'll be self-sufficient and you'll throw off enough margin that you'll own your subniche, right? That's a perfectly rational angel strategy. And so our goal is to get angel investors to explore their investment thesis and to find where the right place for them is. If they want to fight into the unicorn club, which about 20% of our investors do, then we can help them get there. And if they want to do the I want to make an impact, or I want jobs in my community, or I just want companies that I understand how they work, we can help them find an investment thesis for that, which is another reason why we do it in groups of investors, so that you can get the perspective about what the other guy is thinking. And when he says this little blurb and you like totally disagree with it, now you know that that's not your investment thesis and you should go somewhere else. So our investors are getting perspective not on the company, not only on the companies, but also on other people's investment thesis. So if this
supports these different approaches.
I did not understand you.
I think you said SAC supports these different types of companies.
Totally.
Yeah.
Now, understand, we have a bunch of newbie investors who have heard the same story that everybody else is. And so they're trying to frame everything in their mind. And so it's sometimes a little rocky at the beginning. But yeah, totally, SAC is all about helping people get a good investment thesis. And I believe that what David is articulating is a perfectly good place for good investments. There's a class of those kinds of companies that might want to be one of the one and done, or might want to be a revenue redemption where they have perfectly good margins, but they need to grow faster now. And then they want to get the angels out of the deal with the better margin they're going to get. And it totally makes sense as an investment strategy.